Hi, well, good afternoon, ladies and gentlemen. This panel is talking about natural catastrophe risk, which in some ways is a bit old hat in the City of London, you might say, an issue that's been dealt with for decades, and yet climate change is making it more urgent and more pressing than ever. Recent data from FloodRe, which some of you may be aware of, suggest or show that 2025 was the 6th consecutive year in which insured losses from natural catastrophes exceeded $100 billion. Included in those numbers were the $40 billion from the wildfires in Los Angeles. You'll remember those like cinders. I hope you can still hear me. Thank you. That was going so well, wasn't it? $100 billion, I said. Yeah, $40 billion of that came from the wildfires in Los Angeles. That was the costliest wildfire ever recorded. This is not just one-off events. This is a long-term elevated trend. The statistics from FloodRe show that we should be expecting Nat Cat losses to rise on average by 5 to 7%. Munich Re, in a similar report, makes the very clear link to climate change. They say, and I quote, "It is striking how many extreme events were likely influenced by climate change. A warming world makes extreme weather disasters more likely." And frankly, a warming world is what we have. If you look at the latest numbers coming out of UNEP that talk about the warming trajectory that we're on, and this is a very, very big if governments deliver on their nationally determined contributions, their emissions cutting goals, as stated in full, we could be on track for 2.3 to 2.5 degrees of warming. Of course, that's very unlikely, and on a current policy trajectory, we're on course for 2.8 degrees of warming. And then in terms of hot weather, a warming world, this year we're talking about very strong chances of an extreme El Nino. So 40 degrees temperatures in London, things that we saw a few years ago, may be back on our radar. Now, this is a lot of words from me, and we haven't talked about the protection gap yet. We haven't talked about uninsurability and the risk of that. There's a lot of things that we want to cover in this panel. Essentially, we're asking the question, or we're going beyond the question of asking, is climate change and the natural catastrophe risk that I'm talking about, are we moving beyond an existential stress test for the market? It seems like that's a self-evident case that we are. And looking at fundamentally, are there different ways in which those risks can be managed? We have a lot to cover. We have a fantastic panel. We have 2 representatives from insurance, and we're also lucky to have a client of insurers to tell you what it's really like to be on the other side. So Matthew, I wanted to start with you, if that's okay. Could you give us a feel for how climate change and development patterns are creating new catastrophe exposures for the business that you operate, which obviously has a global footprint and a global supply chain?
Thanks, Alastair. Yeah, great to be here, and hopefully I'll give a few nuggets of insight on Coca-Cola, and hopefully you can take that back to your organizations. I've been with the company 14 years, and we originally started out as a European-based only company. Nat Cat just wasn't on the horizon. But 5 years later, we bought businesses in Asia Pac, and only 2 years ago we bought the bottling business in the Philippines. And if anybody's been to the Philippines, it's very much like, if you've seen the movie Bruce Willis and Armageddon, it's got all the Nat Cat perils you can ever imagine, but not including comets. So that's really changed the dynamic for me as a business, because I now get calls fairly regularly, and I'll give you a good example. When we acquired the Philippines in 2024, later that year, in October to November, 6 super typhoons in 30 days. So we had an incredible amount of Nat Cat exposure and claims to handle. But I think what's really changed for me is more of that enterprise view. Certainly with some of the businesses we've got in Asia Pacific, you will be away from FloodRe reports they talk about the risk gap, the penetration gap. And so many times when we have maybe a major loss, we'll look at what we have front and center in our operations. And yes, we might well have some degree of insurance, but when we look at our suppliers and we look at our customers, we look at our consumers, 90% roughly is a hit rate in Asia Pacific in emerging economies where there is no insurance whatsoever. So we might be resilient in some shape or form with some form of financial coverage through insurance, but when we're looking to work with our customers, suppliers, all of a sudden that economic loss far outweighs the insurance claim itself. I think the other thing though is Nat Cat is not just in Asia Pac. You sometimes always have to look at what's on your back door. And our single biggest event was in July 21, when the European rainstorms hit Belgium and Germany. And we had 2 factories with about 50 million euros of flood losses. So what we've seen is very much more that shift to the secondary perils. I know that they're talking now about the shift from first to secondary. The FloodRe report that just came out for 25 talked about, 90% of 2025 Nat Cat was secondary perils. So it's really changing, I think, how we look at risk assessments, how we look at modelling.
Well, the model, Perry, were you going to jump in there? No. We'll come back to you then.
Thank you.
Rachel, I wanted to pick up with you the point about modelling, because what's interesting around some of the modelling is whether essentially the pricing and coverage, given catastrophe losses are now growing so large, are they growing outside of the parameters of what the models suggest? And if so, how do we deal with that risk? That seems like a bit of a problem.
Yeah, so the insurance world is pretty good at this natural catastrophe modelling. As you alluded to earlier, we've been doing Nat Cat for a while, but actually it's almost as if the world has in the last 10 years really, and particularly the last 5 years, really sort of become more attuned to the fact that all this Nat Cat risk is being borne by, or an awful lot of it is being borne by the insurance market. And actually perhaps that's the point, is that not enough of it is, that there is still this gulf between what is insured and what isn't. But so these models, which are largely based on sort of historic event sets and the probabilities that these determine, have been hugely influential in helping companies like my own manage catastrophe insurance, manage sort of the aggregation of it, and just to sort of demonstrate where that's had an influence. So when we talk about the protection gap, which is currently sort of roughly sort of 60-40%, so 40% of the catastrophe economic loss is 40% is insured, 60% is not insured. And that's sort of globally. That is obviously a very different picture when you talk about emerging markets. But that figure was 85-15 in the 1980s. So in the early 80s, there was only about 15% of Nat Cat globally was insured. So we've come a long way. So whilst we are attuned to the fact that climate change is making some perils more difficult, we actually sort of have to remember that 40 years ago, we didn't have models. We're in a better place now. And, we're not underwriting everything exactly according to the model, but they are extremely helpful particularly in this business of aggregation and in helping estimate. But what climate change is doing is making certain perils, certain geographies, clearly making, and in some perils particularly so, like flood, wildfire, etc., making that uncertainty that is inherent in any modelling of hazard risk much, much greater. And that is very difficult. So there are now there are bespoke models. Some of the big vendor modeling agencies have sort of climate catalogs. There are ways in which they're trying to overlay what is the next sort of 20 years, kind of what is that going to look like? And as you said earlier, this sort of going to 2 degrees is pretty much baked in at least.
Yeah.
So the emissions that are there, we categorically know that is going to cause increased warming for the next 10 years. So what is that going to do to the hurricane risk that is such an immense risk to the London market? What is that going to do to increased wildfire and indeed and flood, etc., and indeed secondary perils like severe convective storm? So there's a lot of work going on. There's a lot of very good work going on in universities trying to sort of refine these models that are so. The modelling world has been very much led by 2 big, very sophisticated, good companies, but there is a burgeoning sort of smaller, more nuanced models that are really trying to look at how climate change can impact and how, insurers can then use them and benefit from it. I think as insurers, you really have to dig into it more deeply now.
Right.
And not only dig into more deeply the hazard risk, that is one element of it, and it can be quite easy, particularly if you're a little outside of the industry and you're seeing the news, etc., to think that it's all about the hazard risk, that it's all about climate change impacting that hazard. So that's why it's really important for us to understand well kind of what is the hazard, what is the exposure and vulnerability. So, for example, where are the buildings built? Like, what are they built of? That is important. Are these increasing loss costs? To what extent are they climate change driven? To what extent are they inflation or supply chain costs like driven by COVID or driven by the current Iran war? So just getting that sort of forensic insights into these loss breakdowns is really important.
Interesting. Well, we're going to cover the protection gap, and Perry, I'm about to come to you, but I was very interested in your comment there about sort of the progress that's been made on the protection gap. I guess if you marry that with what you also said about the warming world and how some hazards are clearly going to be increasing in coming more often and more severely, do those things sort of, is there a risk that some of that progress is reversed?
Yeah, look, it's challenging, and we've got somebody from FloodRe, so we can sort of talk about that as an example in a bit. But yes, and we have seen there was a case sort of about 5 or 6 years ago where some insurers, reinsurers sort of walked away a bit from some elements of nat cat risk, partly the pricing has to be right. Yeah, well, that was more sort of just at the sort of coping with the extremes of it. But, and California itself will be a case. So it has to reflect, obviously the pricing, et cetera, has to reflect the risk. And if the risk becomes too great, so for example, there are apparently 53% of new homes in the US have been built on high risk peril, flood, wildfire zones. So kind of, and that is going to be reflected in the price. So we do have to work with the other stakeholders, work with the other stakeholders in the economy to make sure that properties can still be insured, are being built in of sensible materials. That's the other thing. We have much more access to good, resilient materials that are not being scaled in the way that would really make a difference. So I think there is much more that can be done to make the world, to make it insurable.
Okay, fantastic. Well, Perry, I'm keen to bring you in here, because central to this discussion is essentially what can insurers actually insure, or what will they actually insure? And FloodRe exists in a very crude summary by a journalist, maybe you can correct me where I'm wrong, but essentially to provide cover where commercial insurers won't or can't. And you've spoken before about the essentially how FloodRe exists to address a market failure. But you've also been on the record saying that FloodRe perhaps unintentionally can spawn, its very existence can spawn other failures. I wondered if you could sort of expound upon that point.
Yeah, sure. You're right. We exist to address a market failure, which had major economic and political consequences.
The market failure is what, just in short?
The market failure for us was not actually the inability to assess the risk, but it was the inability of people to afford the cover that would be needed.
Right.
And therefore, what FloodRe does is effectively work by distributing a subsidy to those people who are usually in lower socioeconomic groups. So that's the social purpose that justifies the politics. When we were set up, the government agreed to spend $1 billion a year on flood defences. In the first 9 years, they spent $8.5 billion, so they're on track. They've got a $10 billion plan over the next 10 years. So in terms of building flood defences, they've really done their piece, but there's only so much concrete you can pour. What we're now seeing is, I think, a lot of the protection gap is actually in a changing nature of flood exposures in its groundwater type event or ground surface water events.
Right.
So it's too much rain in the wrong places. And the flood defences doesn't help there. But individual homes can take a lot of measures for resilience. And we can go into kind of what those kind of things are, because in the UK, we're talking 30 centimetres of water is the key kind of like limit for us. But they need to be incentivised. And our existence removes the pricing signals in the market that would provide that incentivisation. So in some ways, we've corrected one issue, but we've created another. And if I look at the innovation that, say, the home insurance market versus the commercial insurance property market, one has innovated a lot, one has not. And even where we have innovation with some companies who are doing an awful lot in this space, they're gaining no market advantage from it because of our existence. And that is something that we do need to change, I think.
Okay, now your mandate is on paper strictly as defined by the government through 2039, right?
Yes.
But there are some in the market who sort of assume that this vehicle or a vehicle like it will continue in perpetuity, that there'll be some kind of backstop that exists forever.
Yes.
I assume that you would burst the bubble and say that's not true. And I guess what I want to ask all of you really, like, what happens when that the issues around uninsurability, that's when it really becomes home, right? If these issues have not been addressed. When you're not there anymore, what happens?
Well, in the end of the day, we have a problem that caused a market failure that we would like to solve. We can only solve that in partnership with government. And it's not just the insurance industry, it's industries more generally.
Right.
It's the insurance industry, yes. It's the lending industry who benefit a lot from the scheme, yes. But we're also working with the DIY industry, with B&Q, with IKEA, with people who are trying to get the message out in terms of what can be done. We have another exhibit at Chelsea this year in the Chelsea Flower Show. The gardens make a huge impact. So astroturfing your garden is probably one of the worst things you can do for your flood risk. If you like wildlife, it's even worse. But
Right.
people need education and incentivization to kind of take those steps.
Very good. Okay. Now, you talked a little bit about steps that homeowners could take. If I sort of zoom it out a bit, like, if we're talking about, Matthew, we have you here as sort of the corporate buyer, if you don't mind that label of insurance. We could talk about other certain things that corporates can do to mitigate natural catastrophe risk. Is that a conversation that you have? Is there ways in which you think, efforts that your company could take might make it more easy to get insurance, or might get credit for some actions that result in a lower premium? Is that a kind of conversation that you have? And how does it go when you have that conversation?
Yeah, if you take us back a number of years, probably it was a relatively silent conversation. Now all of a sudden it's very much front and center because of the changing dynamics of our business. But undoubtedly, I wanted to pick up a couple of points about modeling. So, we use a lot of modeling, and undoubtedly the sophistication in the modeling industry has gone, leap years in a very short period of time. But as a risk manager, as a buyer, it creates a lot of complexity. In our property program, we have double-digit number of insurers on our program. Each of them are using their own models, and not all the models are aligned. When we're in numerous countries, the maturity, the insight we might have on a model in the UK or France or Germany is perhaps mature in some primary or secondary perils. I take that to Asia-Pacific, and lo and behold, I've got very poor insight. Right. So when I'm trying to look at building resilience or putting a business case together for capital expenditure to actually look at building resilience in the business, it can be very difficult. Also, I think you've got the issue about innovation. So sometimes you've got that dichotomy of ESG, NatCat. I'll give you a real live example. So in Philippines and Indonesia, a lot of our factories have PVC roofs. They're light, so when there's a volcano or there's a windstorm, they're relatively, I would say, resilient. We're now looking to put photoelectric cells, solar panels on top. It took us 2 years, but we've won our battle. But it took us 2 years with lots of studies and testing to show that PVC was actually it can ignite, but it does not add to the fire load. It actually just drips. So we were looking at having to remove roofs, put new steel panels on roofs, or putting some sort of insulation between the PVC and the photoelectric cells. So all of a sudden, it took us a long time. But in a roundabout way, though, I think that's part of the issue. Sometimes that innovation, having a no from an insurer, just makes you get a little bit on your own 2 feet, say, I'm going to prove them wrong, so to speak. And it's taken us 2 years, and I have the pleasure of having an in-house risk engineer who's really gone to town on it. But there's not one answer. Right. It's not easy, but I think a lot of the focus has also been very much on property and about really looking at the value of business interruption and disruption. But increasingly in a lot of our jurisdictions, we're also looking at the impact on our consumers and employees, like heat stress.
Right.
We've got 9 factories in Spain. Those factories are seeing 40-degree plus temperatures in the height of summer. How do we make sure we protect our employees so that they have the right sort of access to cool rooms, so that the behavior doesn't change? They've got concentration when they're working on the job. Because if they don't have it, they're going to cause an accident. So there's a whole plethora, I think, of different things, not just property, that we're going to have to look at for NatCat and climate change.
Rachel, would you come in here on sort of that giving credit piece? Do you have views on that? I'm
not so sure. I'm not close enough to the kind of how how the mechanics of where you may or may not make sense to give credit. But I think working with a client on their specific needs is absolutely at the root of it all. So, the models are good to give you a kind of sense of direction, to get them. They definitely help, but they absolutely, and they're not used by our underwriters, as an example, to entirely dictate pricing. They inform, they build a picture. There's lots of information, and the more underwriting and companies can work with their long term, and I think that's definitely a sort of a key feature of our business, as we want clients for the long term. And if you want them for the long term, you've got to sort of understand this evolving risk landscape, and that Matthew sort of outlined very well exactly how sort of complex and that is becoming. So I think understanding that risk and understanding, and there's, if you hear what he's saying, there's opportunity there as well, right? There's sort of new risks and stuff, extreme heat. We're not doing much in the way of extreme heat, but there's a lot of sort of, if you talk to the NGOs, etc., there's a lot of good work going on, and understanding that as a real risk issue. So I think understanding understanding the risk profile, understanding where their needs are, and then that will be reflected. And it's a competitive market, right? So it's then reflected in the overall pricing.
It's good that you talk about opportunity, because a lot of what we've discussed is rather doom and gloom, so it's good to have that other side. I mean, Perry, perhaps it's not as relevant to you, but would you weigh in on this point of opportunity around insurance here?
No, absolutely. I mean, FloodRe's been very successful. It's solved the problem, but we are trying to manage out, because this should be in the commercial markets. If we can do the job right, then it becomes a commercial opportunity. Right. I love hearing, I've been an underwriter, and I hear you're saying, so you're willing to pay a bit more than standard, and we think we might be able to, if we can assess that risk properly, what a fantastic opportunity and bigger market. And that's what we as insurers want.
Right.
Well, always used to be.
Very good. Okay. Well, I asked Matthew, are there specific things that corporates can do to sort of mitigate natural catastrophe risk and be more prepared for the current moment? I guess I want to turn it to the insurance representatives on the panel. Sort of a similar question. Are there things that insurers could do better to be more proactive and less sort of reactive? And one example could be sort of engaging with land use planning. I don't know if that's maybe relevant for you, Perry. Are there certain things that you see as obvious, low-hanging fruit or maybe high-hanging fruit, if we've done all the low-hanging fruit, that insurers could do to sort of push this agenda along? I open that to either of you.
More than happy to kind of come in. There are so many things we can do, and I think a lot of it depends on communication between the insurer and their customer. So, for example, the Environment Agency issued just over 300,000 flood alerts for homes this year. 98-point-something% of them, nothing happened. So when you do get one, you ignore it. But the modeling that we can do, and the insurance companies can do through your app, and then one company has just imported one that's come over from Australia, that makes sure if you get a flood alert, you know you have to act. I think it's great. And then the communication of what could you do. Flooding is people think, oh, well, I need to get some sandbags. Well, actually, no. A 15-pound roll of aluminium tape from B&Q is much more effective. Here's how you fit it. Do you know where your air bricks are? This is how you cover them. Right. And that kind of information and communication from the insurers can make a huge difference in the cost of claims. And therefore, over the long term, whether we need someone like FloodRe at all.
Very good.
Yeah, I think insurers in general have to be much more sort of work outside of just the insurance community. I think the more we can sort of engage with the investor market and the sort of those actors in the financial architecture of, I'm not just building in its broader sense, right? I think that's where we will start to make more of a difference. Quite often people say, oh, but insurers are brought late to the table, or we don't get engaged early enough. But I think the insurance, there was, when I sort of 20 years or 30 years ago when I was first working in the insurance market, I remember people said, EC3 never talks to EC1. And actually I think there is a bit of that there isn't a sort of huge familiarity or sort of, connection between the insurance world and the rest of the city and indeed the rest of the sort of global financial markets. And and clearly there obviously are at certain levels, but I think as a general thing, because insurance is seen as short term, it is what we're talking about here are by and large 12-month policies. So it's sort of procurement, right? There was always BA famously spends more on loo paper than it does on insurance. So it was sort of seen as insurance, so as procurement. So how can you, the value of insurance, I mean, what it's doing, and the fact is, it may be for 12 months, but it's there every year, usually. And if you're saying, right, we want to mitigate that risk over the next 10 years, what is that going to look like? That is a conversation that needs to be had with a broader audience than usually just the risk manager, et cetera, and indeed beyond. So I think that's where we could do a lot more. And I mean, we can talk more about the protection gap, but that is a huge area where there can be more done.
Yeah. I mean, Matthew, do you have you found yourself butting up against that sort of 1 year rolling period in the sense that, you might be able to get something insured now, but especially in some of the markets you've discussed in Southeast Asia or whatever, what's the long-term trajectory, the risk looking like for those jurisdictions? Do you worry about, if it's just 1 year, maybe it's insured now, but it won't be in the future?
Yeah, we're at the vagaries of the market cycle, and there's a relatively short-termism approach. I think a lot of the risk managers maybe that are here today, having a captive can certainly be another opportunity to help alleviate and slightly ventilate that exposure. But I think, Rachel, you mentioned a really good, again, as my research for today's panel, one of the things I really got into was some of our sustainability, our commitments. And we did a podcast, I think it was just the other week. And so one of our key commitments, for example, was on greenhouse gases. And we want to get to net zero by 2040, which is incredibly aggressive. We want a 30% reduction in real terms versus 2019 by 2030. We've made great inroads into that, but when I was speaking to our head of sustainability in preparation for today, they've got all these roadmaps, and they go to investor relations, they're going to key markets, the banks, and they're actually saying, listen, this is exactly how we're going to do it, but beyond maybe 2030, it's a little bit of, there's a lot of technology, we still don't know how it's going to get there. But actually having an insurer and your broker just sitting in to say, right, how are we actually going to get there? We've never done it before, and it's triggered a light bulb moment even just sitting on this panel to say, I think some of our lead insurers, we probably need to just bring them into better understand our business and not just look at that 12-month and maybe try and unravel it and say, listen, if you really want to have a long-term sustainable piece of our pie, we're a good quality company, we're investing, why can't you give us some capacity, sustainable pricing that incentivizes us? We'll put the money where our mouth is in terms of some capital expenditure, but we want you there today, tomorrow, next year, the year after, to help us provide that capacity of coverage, regardless if it's a claim or not, because as soon as a claim, there's always that propensity to run to the hills, but claims do happen. And if they do happen, we just want to make sure we have that sustainability of coverage.
In terms of kind of the relationship between the insurer and their client, I think here is absolutely critical, and there's a lot that can be done. We do something called Build Back Better, therefore offering after a flood claim, you can build it back so it's more resilient, whether that's flood doors or whatever. But what we've seen is the take-up, if the insurance company is there on the day of the flood or the next day, the take-up of that is 90%. And it's not going to flood again. And we'll also see that person, if you've done that claim well, will renew and renew and renew. That's our moment of truth. But I see too many insurance companies who don't turn up for 3 or 4 weeks. And at that point, they're fighting the customer on the phone. And therefore, you've got a war. And the take-up rate of Build Back Better is close to zero, not surprisingly. And I think that's where there are some really, really good insurance behaviors out there when they're sitting next to the client. And we've got to get everybody up to the same level.
So it's less about, as you described earlier, this procurement idea and more about building a relationship and having that. That's where the value is.
I think there's a lot of value created by that relationship of being beside the client, whether it's home insurance, whether it's commercial property.
But I think to your earlier point, I think the insurance market does have a bit of a, whilst we can be very innovative, we do tend to go for the same types of client, the same sort of geographies, certainly the same geographies, the same, it's the sort of low-hanging fruit. And I think your earlier point, Matthew, about, you've got real problems with you've got real risk in your supply chain. And this sort of increased awareness of the fact that the protection gap in the emerging markets is something like it's less than 10% insured. So and what's becoming more, and you may say, okay, so kind of who cares? Well, people, who cares? Not only is it the World Bank, the IMF, etc., but who cares is the Coca-Colas of this world who have a dependency in that. So, and that is new risk for us. That is new fruit. We can understand that. We like catastrophe risk in this world. In this in Nat Cat insurance world, we like it. We want to understand it, and we have the tools to understand it. But it's just that sort of, it's in that case, it's this sort of accessibility. It's harnessing it. It's working with the World Banks, the multilateral development banks, etc., on how you can do it. There are good parametric solutions, etc. It can, there are all the tools in the box to do this, but to scale it is what really needs to come together. And there's the Insurance Development Forum, which many insurers are part of, is making huge inroads in trying to do that, including with a suite of risk modeling tools for the very areas of the world that we've been talking about. So I think there's huge opportunity if we get a grip.
Get a grip. Very good. Okay, we're going to move to some Q&A now. We've got a few questions here on the Slido, and we will do some, if anyone wants to ask a Q&A question from the room, we'll have some roving mics. But I'll start with the question that we have submitted on Slido. So, Matthew, I think this might be for you, but please, all of you chip in, don't leave Matthew stranded. It says, from a corporate buyer perspective, is climate resilience being recognized as a source of value and as a competitive advantage, or are firms still largely treating it as a cost of risk? A cost of risk transfer.
I like to see who in the audience asked that. I'll speak to them later.
It's anonymous.
Anonymous, okay. Again, I think there's a changing shift. Again, if that question was asked 10 years ago, I think it would probably be a little bit radio silence. But certainly for a company, and again, speaking personally, Coca-Cola, for us, if we're going to survive as a business, we've been around for 140 years. If we're going to survive as a business, we've got to resonate with our customers and consumers. So something like brand, it's having credibility. We want to be around the next day. Some of our competitors might not invest in the right way. They might not be around. But as a brand leader, we've got to be there tomorrow for our customers. So we're seeing opportunities on climate change. I'll give you an example. We're getting more into 100% of our target on electricity is from renewable sources. So we'll have less reliance on some of the geopolitical issues that are coming around just now. Our packaging, I was just looking at some of the numbers. We make 44 billion packages in the 31 countries that we operate in of Coke-related products. We're moving in Europe, 100% of some of our packaging is totally recyclable. How do we actually build that and sell that to the consumer? And that creates that sustainability piece. Again, there's no silver bullet. No. But undoubtedly there are some, I would say, business cases about, for example, on packaging, looking at the mix of packaging, lightweighting plastic, recycling, investing in JVs that we can look at deposit return schemes. I think it's in October 27, we're going to see a deposit return scheme in the UK, and we're fully supportive of that because we'll then see a feedstock of aluminium, PET that we can put back in the circular economy. It's not easy. It takes a lot of time and effort, and clearly there's a lot of other, I would say, distractions for senior management to kind of look at about the future success of our business. But climate change and climate resilience building is seen much more front and center of our day-to-day operations.
Cool, thank you. Let me ask a question that's come in to the insurers on the panel. And it says, do you think insurer attitudes to secondary perils, we talked about how the Swiss Re data is showing that secondary perils is dominating now. Do you think insurer attitudes to secondary perils need to evolve given they are growing? Given they're growing.
Yes, I think the answer. It's in the data. So I think, and again, the modelling probably has not focused on the secondary peril so much. So it's sort of having to sort of do a gear shift in addressing that. But absolutely, and then it's the kind of severe convective storm in the States is a big secondary peril that's affecting a lot of people, but there are other secondary perils. So I think that, and I think perhaps the idea of how climate change is affecting different perils is very much a growing picture. And so I think it's shining a lens on that.
Matthew, another question for you. Actually, Perry, there's a question for you. Let's not pick on Matthew too much. There's a question that says, public-private schemes, e.g. FloodRe, was designed to address clear market failures. You've talked a little bit about what that market failure is and how you're addressing it. The question is, how do you see their role evolving as the protection gap widens? We've been talking about how that's growing. Like, surely in theory, there's more need for a FloodRe or FloodRe type vehicles.
Well, I think the FloodRe model can work, and it has been very successful in the UK in dealing with the challenges it had. And it's a model that can be exported around the world and adapted for those markets. But it buys time to make the economy resilient and adapt to the climate change or whatever the perils are as necessary. It doesn't necessarily need to go on forever. And I think that's the challenge we have. A FloodRe mechanism is great at buying time. And I think if we allow it to become permanent and rely on it to be permanent, we will not be doing our customers or the industry a good service.
Agreed. Okay, also a reminder, if any of you want to, in the room, put your hand up and ask a question. We'll have a roving mic. But we're getting some great questions coming in on here too. There's a question that says, are insurers still focused on modeling present-day Nat Cat risk from an annual underwriting perspective, as opposed to modeling future changed climate risk? I mean, that kind of goes back to our discussion
We've sort of talked about that, but I would say everyone is now looking at, particularly on certain perils, is looking at what is climate doing, what is climate change doing on the future, and particularly, say, the next 10 years. I think, there's a lot, and, we all have to sort of anticipate what that's going to look like on a longer time horizon. But certainly, the next 10 years is that. And it's not just insurers, right? Investors are now looking at the investor market. If you talk to the investor market 10 or 20 years ago, they may have had some very sort of, I think, rudimentary hazard models. Yes. But now they are really looking and sort of quite impressed by what the insurance world does in this way. But they are using, if you're investing in infrastructure for the next 20 years, not only are you interested in, and this comes back to other parts of the world that needs that good modeling and this sort of need for that, not only are you interested in where that the features around it and the risk profile of that building, but also the kind of, the roads going to it, the infrastructure around it. So I think it's getting a heightened awareness and profile sort of more broadly.
So the winners are those, if you'll accept that term, the winners are those with the best models. Is that fair? And is there therefore an arms race to hire the best data scientists or the best climate modelers? You can imagine that.
I think it's how you use it all. It's not, the answers are not all in the models, right? There isn't a perfect model. It's an interpretation of that and a lot of reading, a lot of understanding. So it's not that simple.
All models are wrong and some are useful.
Yeah.
Very good.
It needs that judgment.
Okay. And another question would be, we talked about sort of the capacity issues earlier around insurance. One sort of related thing is, can you, one way maybe to increase capacity is sort of spin out some risk to the markets, to the capital markets. You talked about earlier about this sort of interconnection between insurers, investors, banks, and so on. And of course, that leads me to ask about sort of cat bonds and parametric instruments. Perry, please all chip in, but Perry, I want to ask you about that because, of course, FloodRe issued your inaugural cat bond, I think, last year, and talked about maybe doing an additional one. Like, how do you think about sort of that casting off of risk in that way? And what's the capacity? Like, is it just...
Well, I don't think we call it casting off risk, but risk transfer mechanisms.
Risk transfer, very good.
Yeah. Look, there's a number of investors that wouldn't have invested or given us capacity. In the end of the day, we buy reinsurance because we don't have the money ourselves. Right. So that capacity comes from the capital markets. That's a huge market. Cat bonds are small, but it's growing. So it's a really useful mechanism for us. Parametric bonds, I think, in the Caribbean, really useful. It's not what would work for us. Parametrics work really well when you need to get cash into somewhere quickly.
Right.
So, it's understanding who would invest, why, and what mechanisms you can use. But I think there's a huge number of ways that the traditional reinsurance markets, it just fits into the capital markets in a certain way. And that's not always the best way for the investors that want to take the risk.
Okay, good. That's a nice way of answering it. And that leads me to a great question here that's directed to you, Rachel. You talked about, as I just mentioned, sort of this dialogue between insurers and the rest of the city. I think you said EC1 to EC3. Yeah. I like the way you phrased that. And the question is sort of what form could that take? And how could financial stability regulators be incentivized to facilitate that discussion?
Well, I think in the instance that I was talking about, it was about investment and a 20-year investment in buildings, etc., and having an insurance engaged in that, or indeed in transition related to building materials, etc. I think it's that. But I think a really good example of having capital markets more invested in insurance is ILS, is cat bonds. I mean, they are a brilliant tool for having a very easily defined loss trigger and the mechanism behind and the sort of investment, the structure of the investment set up such that insurers or investment markets can invest in them. And they've been going for 25 years. They are now massively, they're quite a sort of decent sized market now, albeit nothing on the scale of the reinsurance market, but they are very effective. There's a great example of where, and this sort of links us back to this protection gap issue as well, but the government of Jamaica bought a cat bond for its Hurricane Melissa, which happened last October. And that as part of a sort of broader financial arrangements they had of a credit loan from the World Bank. They were part of a Caribbean pool, but this money they had, this indemnity they had bought from a wind-triggered parametric ILS was triggered by the hurricane last October. 2 months later, they got an upgrade in their sovereign credit rating as a result of their good financial management and Moody's, who gave the sovereign upgrade, cited the cat bond in this. So it really shows you why it makes economic sense for them to do additional mitigation and parametric trigger allow them to do that. So I think, and that could really be the solution to expanding the footprint of insurance mitigation in territories where it isn't. So I think the capital markets could really sort of get into that in a bigger way.
Fantastic. Matthew, a question for you, and this is an opportunity with our time almost running out to say what you really think about insurers. This would be a great moment. It says, do you perceive insurers to be keeping up with emerging technology and innovation? We talked a little bit about innovation of insurance structures to enable you to drive your business forward. And how important is this to you?
Probably need a lawyer. It's a really good question, but interestingly, speaking to a number of risk managers over the last couple of days, we've talked about penetration gaps on things like natural catastrophe and climate change. But if we look at where our book of business was, our reporting annual accounts 10 years ago, and we looked at our list of registered risks, there was probably a relatively high correlation, I would say probably 30-40%, with some degree of insurance for those risks that were in our integrated financial report. Today I look at it and it's probably 10% or less. The insurance, certainly at the C-suite level, there's more and more discussions to say what is the relevance? How relevant is this insurance to the key risks at the enterprise level of the business? That's not to take away what's happening on the operational risk side, which is more my forte. But certainly, one of our businesses, we have what's called a CCEP Ventures, and again, a lot of the companies here today, they probably have some sort of business within a business that looks at, seed funding or angel funding businesses with new technologies and whatever to address some of these climate change issues. And some of the conversations I know that those businesses are having is it's really hard to stay in business because the insurance companies themselves they're in the driving seat, but they look at the mirror, they look backwards to figure out how can I price something going forward. These businesses don't have a mirror in the car at all. They're just moving forward. They're just saying, we want to come up with an innovative solution. So you have that real tension. And what we're able to do is perhaps try and break that down and give them some assistance. I think the insurance industry could be bolder. I think we've got to break away from the short-termism and perhaps having a more of a kind of public-private client, a real go at it, being bold. It's not going to work for everybody, but I do think that's the ultimate solution.
I think we should have started with that, shouldn't we? That was fantastic. Well, we've run out of time, but the message is be bolder. There are big risks. Let's be bold. Please join me in thanking my panel. Thank you very much.